Good afternoon, traders, and welcome to none other than Stock Market Movers, where we give you all the headlines in today's action and, of course, get to two expert opinions every single day. That's what we're here to do. Get you that informational edge that you guys are looking for. So let's go into today's topic and see what we see on out there. Today, we're going to talk about dead cat bounce, consumer confidence index, retail stocks, April home prices, ARK Invest, bank dividends, Warren Buffett, Nike, Robinhood, Disney, cryptocurrencies, and Airbnb. All those topics covered right here on none other than Stock Market Movers, where we cover everything in just about 1 hour. We'll get into it. Let's talk about the guest for today. I'll throw up the topics here for you guys to go ahead and check them on out. You guys can see them down below. We get to all this action right here in a 1 hour period. Now, one thing to always keep in mind is that we are going to have some great guests. So today we do have some great guests. We're only going to have one new guest today. I did have a cancellation for that 145 spot. Not going to put someone on the spot and tell you guys who canceled, but if you guys caught it a little bit earlier in the description, yeah, we had a little cancellation, but we still got an interview here at 1:15. Lance Roberts, chief strategist of RIA Advisors and editor of Real Investment Advice, will be here. We've had Lance Roberts on Money Mitch before, and he's going to have a great opinionated show here for us. The reason why I like to get to Lance is that he covers this on a daily basis just the way I do. We'll get to Lance Roberts coming up at 1:15. Let's go ahead and dive in all these topics. Let me know in the chat if you guys like me going through the topics in this kind of speeded up manner and not just getting stuck on one topic, but rolling through everything and taking a look, of course, at the markets. That's not, we cover it all here on Stock Market Movers. Let's get into it. Let's take a look here. All right, overall market, what's going on out there right now? So it looks like we're getting a little bit of a pullback day today. I'm going to go ahead and let me take away some of these indicators so you don't see too much on the charts here. Just have way too much here for you guys to kind of get a little confused there. Let's go ahead. Let's make this full screen here, and I'll share my screen with you guys. Check it out on the SPY action here. We'll talk a little bit about that. Yes, we got our guest coming up. But was this just a DCB? DCB standing for dead cat bounce. Of course, that's what we're all looking at. And is this a dead cat bounce? I mean, really the only way to know is if we come back and we kind of take out the lows. But definitely you guys can see in from kind of those bottoming actions that we had on June 17th, just up in about 11 days, we're up about 7.84%. So we are starting to get to the point where you're starting to see that turnaround. What happened last time we saw this, right? I mean, we did get a bounce up here that was about 9.5%. And before that, we had also gotten a bounce here. And you guys can see here, it also bounced here about 5% on this first kind of move. So 9%, 5%. Now we're getting about 7%. So it looks very similar to the patterns that we've continued to see, and letting us know that these rips could be rallies to sell into. I think that's what we got here. And like always, we won't know until we continue moving with the markets. And like always said, like my favorite song from Jimi Hendrix, nobody knows. Let's keep going. Let's go into the next topic here. Of course, we got some major data points coming on out today. I think it's important to kind of keep on eye. Of course, the consumer confidence index fell to a reading of 98.7, down from 103.2 in May, and missing a Dow Jones estimate of 100. So definitely the consumer confidence definitely dropping down here. Retail stocks really paying the price on this. Let's go ahead. Let's take a look at some of these retail stocks. Stocks like Macy's taking a hit on this. We could take a look at some of the other names in here. You guys are seeing KSS also down about 1.5. But look at Nordstrom. Nordstrom getting knocked down about 4.4 today. So definitely seeing some weakness in retail after this number came on out. That's not the only number we got. Of course, we got more than one number. We're going to keep it going through here on the topics. Let's keep it going. Let's get into the After the retail stocks, of course, we got April home sales. I think this is important to watch. We've been getting some strong earnings from Lennar. We also got it from KBH. Now let's pay attention to the real estate and how's it going? Are we seeing a slowdown? Are we seeing cooling off here? Let's go ahead. Let's take a look at the numbers. I'll go ahead and I'll pull up Lennar so that you guys can see how that's performing today. But like always, we're going to keep on watch to see if these can hold the gains. Let's go ahead. Let's take a look here. Lennar definitely trying to get back up there, showing a little bit of weakness today. And what did we get in the numbers? So prices rose 20.4% nationally in April compared to the same month a year ago, according to S&P CoreLogic and Chiller's and Case Shiller's index. In March, homes grew 20.6. And so you could see a slight tick down from that 20.6 to 20.4. Where is this coming from? This is showing a little bit of a slight cooling down, at least from the signs of course, the housing market getting those increases in interest rate hikes, showing us that they are having an effect on the housing market. One thing to keep in mind, though, is how's this going to affect the supply, right? We're affecting the demand, but also the supply is increasing here. Active inventory last week was 21% higher than it was the same week 1 year ago. That's from realtor.com. So wanted to go ahead and get that to you also. And keep your eyes on, guys, because if the supply continues to get bigger, we're already knocking down demand here. It's going to get pretty tough in the housing market. I'm just going to kid it out there. Just red flag. Keep it on radar. We'll see what happens there. But definitely today's numbers coming in slightly lower, showing that cooling in the housing market and a lot of that coming from the interest rate hike rate. All right, let's keep it going. Let's go towards ARK CEOs. Cathie Wood here stepping up to the plate. We know that we've been watching ARKK. It has been finding a balance as of late. Let's take a look here how it's doing today. Definitely pulling back a little bit. You could see it pull back from those highs up there around the 46. But Cathie Wood Invest coming on the Squawk Box on CNBC this morning. And some of her comments, she said Tuesday that the U.S. was already in a recession. We think we are in a recession, she said. We think a big problem out there is inventories. The increase at which I've never seen this large in my career, and I've been around 45 years. Words coming from Cathie Wood. She also stated, we are wrong on one thing, and that is inflation as being sustained as it has been. She wasn't expecting that. If we go back, she was calling for deflation a couple months back. Supply chains can't believe it's taken more than 2 years. And the Russia invasion, Ukraine, of course, we couldn't see that. Inflation has been a bigger problem, but it has set us up for deflation. And those are comments coming from, of course, CEO Cathie Wood. We'll see what happens there. Several banks. Let's go towards the banks now. Let's keep it going and rolling here. Let's get into the bank talk that you saw this morning. We could take a look at that. Let's just pull up the financial sector here. You guys can see how it was rising up in the pre-market, definitely gapped on up there, trying to push. This is my sector that I keep an eye out. And several major banks raised their dividends after successfully passing the Federal Reserve stress test. Bank of America, Morgan Stanley, Goldman Sachs. Let's take a look at BAC here. BAC pulling on back there after that kind of pre-market push. But what happened here? Bank of America raising its quarterly dividend to 22 cents from 21 cents. Big raise there. I didn't see too much there that would draw my attention. But Morgan Stanley definitely was taking a next step on up. We could take a look at that. And also, of course, Goldman Sachs also raising their dividends. So you guys can keep an eye on what happens there. Morgan Stanley was kind of raising the most in the pre-market, was up about 4.8%, almost 5% there on Morgan Stanley. And they raised their dividend from 70 cents to 77.5. Goldman Sachs raising their dividend from $2 to $2.50. Now, we did get mentions from JP Morgan and Citigroup that they weren't going to be raising their dividend. A lot of this due to stringent capital requirements that are needed, but that wasn't the worst news. Of course, what you didn't want to see them is dropping the dividend, because that would have been, I think, more of a sign of concern. Let's keep it going here as Warren Buffett taking another shot in Oxy here, adding to the position. I talked about it as, a lot of times you hear about this adding to winners, right? And I think Warren Buffett taking the shot here, reported purchase of 794,389 shares. Warren, if you could do me a favor, maybe round that up next time, but can't blame you. The shares of Occidental Petroleum Corp at an average price of $55.39 here. So, I mean, we could take a look here. $55.39. I mean, not a bad little buy there, average. It was down here at the bottom, buying each day that it was down here at the lows here on the range. So definitely making a little money on the bounce back. We're seeing Oxy kind of push back on up there. We'll see if this can continue making a drive. Was this more of a correction pullback opportunity in energy, or was it demand destruction? We'll talk a little bit about that coming on up in our interview. All right, I got through a lot of topics there. I think we got through like 5 or 6. So please do me the favor. Give me a thumbs on up if you guys enjoy the fast pace of the show. Let's keep going. Let's get into our first expert opinion today. Like always, that's what the show's about, trying to keep you guys in the informational edge and trying to keep going at a fast pace. So let's keep it going. Up next, we got Lance Roberts, Chief Strategist of RIA Advisors and editor of Real Investment Advice. We'll be jumping on into a lot of topics like inflation, recession. Like always, guys, hit the like button. Let's go ahead and get it started. I'm going to play a little trailer, and we'll bring on Lance.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and re-educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
All right, let's dive on in here. Lance Roberts, Chief Strategist, RIA Advisors, and editor of Real Investment Advice. Welcome back, and glad to have you finally on Stock Market Movers.
Glad to be here.
Excited to go ahead and get into it. You guys see the action going on in the background there. What I love about Lance is that he's definitely in the works every single day and does kind of similar to what I do. He's covering and I think that's important. So definitely, if you guys want to check that out, I put the description, his website down below, Real Investment Advice. Check that out, guys. I always go on to RIA Advisors, and you guys can check out some of the content they do. Either it's on their YouTube or it's articles getting put out. I would definitely check them out. Description down below will get you to it. But let's jump right into it, Lance. We're seeing a little bit of a cooling off action today. Now, the question I come to you is this more of what we've seen in a relief rally, or is this more along the lines of, you think, a bottoming action that we saw?
And it's too early to call a bottom right now. And the reason is that, as we look at where we are, this week in particular, this is the end of the quarter for the second quarter. So we've got a lot of rebalancing going on inside of portfolios, $30 billion to be, rough kind of round numbers for this week. Moving into July. Now, July tends to be seasonally a little bit stronger month. And look, we've had a couple of really tough months. May was a tough month, and the only reason the returns weren't more negative in May is because we had a last week rally in May that basically wiped out all the losses for May. June is kind of stacking up that same way right now. So again, if this market can kind of rally over the next couple of days, might pair some of these losses for the month. But like I said, July tends to be a little bit better. August and September, those are months that we need to worry a little bit more about as we get into kind of the seasonally slow period of the markets, and particularly moving into the end of the year. The big issues here right now that the markets are struggling with. Yesterday, you had the Dallas Fed Regional Manufacturing Index come out showing very sharp slowdown, not just in the actual headline index, but in new orders, expected new orders, prices paid, all taking very big downturns. That's going to lead to more recessionary talk here over the next couple of months. Today, the Richmond Fed exactly the same thing. I mean, across the board, when we look at indicators economically, they're all pointing to fairly sharp, substantial slowdowns in the economy. Now, this is deflationary. And we talked about earlier this year that this inflation push we're going to have is going to be temporary because high prices will solve high prices. And now we're seeing that process come through the markets.
Perfect. I think you're hitting it on the nail here. Let's start talking about inflation. What are you looking at in, let's say, the next 3 months? How do you see inflation playing out? Do you see a topping already, or maybe you could see topping coming? What do you see?
It's going to be, and so the interesting thing about inflation is if you go back and look at history, whenever you have more than a 5% annualized rate of change in inflation, and we're currently about 8.6, 8.7, that is typically, well, it has, all going back to 1960, always preceded a recession. So when you have a recession, you have a very sharp contraction in inflation. Now, this is the interesting thing about inflation. Inflation doesn't just move up and then kind of gradually come down over time. It's straight up and straight down. There's a very sharp decline because of the recessionary impact that is set by a slowing economy. Now, let me just clarify one thing. I'm not saying we're going to have a recession. There's lots of talk right now that a recession is inevitable. And as you and I both know, there's only 3 things in this world that are inevitable. It's death, taxes, and Thanos. Outside of that, pretty much everything has a possibility of, not doing exactly what we think. So could we just have a slowdown, a very short-lived kind of temporary pullback, and then the economy start growing again? Sure, it's possible. However, given how we got here, the reason we have inflation, $5 trillion worth of liquidity, you shut down the economy, you had all this demand, no supply. And as you were just talking about a moment ago, now all these companies have gone back, previously have run in and built up all this inventory. Now nobody has any money to spend. So now these manufacturers and producers have to liquidate this inventory, which means that going upstream, all the orders for commodities, any type of input good that goes into manufacturing a product that you buy at Target or Walmart are also going to see slowdown in orders. So this is what we call a bullwhip effect. We had the bullwhip. So if you think about how bullwhip works, right? I whip my wrist, the bullwhip goes out, cracks at the end, and comes flying right back at my face. So we had all this liquidity. That was the bullwhip going out. Now the reversal of that is no liquidity. All that's got to come back in the other direction very quickly. So you're going to have a very sharp downturn in inflation. Problem is, for the Fed, is they're going to get trapped very quickly between trying to hike rates and slow the economy and trying to combat a recession.
Yeah, it leads exactly to the question. Do you think the Fed will turn more dovish if we do see inflation topping out?
Well, by the way, I didn't answer your question fully. You asked me if I saw inflation topping here short term or a little bit further out. I didn't. I missed the one point there. The way we calculate inflation is a function of housing prices and energy prices and these type of things. Well, the inputs into CPI lag. We use a 3-month average of oil prices. So that's a lagging indicator coming into CPI. Housing prices run about a 2 to 2.5 month lag before they get into CPI. So you're already seeing housing prices come down. You're starting to see a lot slower activity in the real estate market. That hasn't shown up yet. That's going to show up in the next month or two. So while we may not see inflation, peak substantially here in June or July, probably by August, September, we will be able to look back and say, yep, there was the peak in inflation, and now we're going to have this deflationary trend. Now, to your second question, the Fed's going to have a problem here. They're talking about aggressively hiking rates to combat inflation, but inflation's not going to be around long enough for them to do much. And despite their rhetoric, right? Their rhetoric is, we're going to combat inflation, so we're going to hike rates. The reality for the Fed is they can't get caught in a recession at 0 interest rates. They've got to get rates up to 2.5% or 3% so they can lower rates, because that's the only tool that works in a recession. So they've got to get that interest rate up, and it's a race against time now for them hiking rates before they crack something in the economy and have to revert back to, or pivot, as we've been all talking about lately, before the Fed pivots back to more monetary accommodation.
Definitely, I think it's important to keep that in eyes, and we can't go into a recession with the interest rates being so low.
Right.
What do you feel is the best measure of inflation? I've heard you do a podcast on this, so of course I would tell you guys to definitely go ahead and check out that podcast. It's a little bit longer than we'll probably talk about it right now, but Lance, maybe give me the quick rundown of what you went through in that podcast, and of course, maybe leave a little bit so they can go ahead and check it on out.
Yeah, no, the best measures of inflation, we talk about CPI, we talk about PCE, we talk about all these different things. And, there's not a great measure that we look at because inflation is so different in so many different parts of the country. For instance, in California, inflation is very different than in Texas because gas prices in California are $7 a gallon. They're $4.98 a gallon here in Texas. So, you have very different measures. And so using these kind of broad sweeping measures of inflation really don't capture what the impact is for the average relative person. And this is the thing we've got to remember. So when we're talking about inflation, we're talking about the cost of living. And the measure I like to look at is I take CPI and I strip out healthcare and I strip out the issue of rent and mortgages because those things are mostly static for everybody. For instance, if you're working, you've got a company provided healthcare plan, your healthcare is paid for, every month out of your paycheck, and it's the same payment every month. And so there's no one. So while inflation, it may show a change in healthcare from one month to the next, it's not being impacted to you. If you have a mortgage or you're paying rent, that's contractual. So that doesn't change for you. So once we start stripping out those measures to look at what people are really paying to maintain their standard of living, it's a much different picture. That inflation rate's nearly 11%. And the reason that's important is because that's what people are dealing with right now. We're starting to see a very big surge in credit card debt. We're starting to see a very big impact in terms of people making purchases. We just saw retail sales just this past reading went and fell by 1% annualized. Now, they went from a positive 7% to a negative 3%. Now, the important thing about that is that while retail sales, which we measure in dollar volume, fell by 1 percentage point, remember prices are higher. So the actual volume of stuff that we're buying actually fell a lot more. So it was a much bigger downtrend in retail sales than just what the headline portrayed. But that's the problem that the average person, the average American, 80% of Americans live paycheck to paycheck. That's what they're dealing with right now.
Definitely. Now, one of the areas that I'm definitely keeping on watch is, of course, energy, right? And we've been all kind of keeping on watch. Is this more of a correction, pullback? Is this an opportunity to get back into the rally? We saw Warren Buffett taking a little bit more shares of Oxy. Definitely don't try to fight Warren too much. I never try to do that one. But what do you think is really needed here to really start seeing some stability in energy and continue to rise?
Well, so two things, energy and inflation are very much kindred spirits. And if you go back and look over time, spikes in energy and spikes in inflation work very closely together. Unfortunately, when inflation falls, because you have a recessionary environment, so will oil prices. It's a supply demand game. And so as you get into a recession, demand falls, expectation for oil production, declines. And so you get this decline in energy prices. That's inevitable. We actually just did buy some energy stocks yesterday because we've had a very big correction here. They were due for a bounce. Yesterday, early morning, we bought a little bit of energy into our portfolio. That's a trading position for us right now. We'll eventually probably wind up reducing that at some point here. But if we begin, but importantly, if we begin to start to see a disinflationary or a potentially recessionary environment, you're going to see oil prices come down probably towards $60 or $70 a barrel. That would actually be a good thing because then you could get back to a range where you could get more price stability in these companies. But the bigger issue remains the administration and their kind of goal to attack the production capability of energy companies. While the administration saying oil companies need to produce more right now because they have record profits, that's not true. Actually, record profits for companies like ExxonMobil really haven't grown that much because all the input costs for ExxonMobil to drill a well or refine product has also gone up: labor, input cost, everything else. So their profit margin really hasn't improved that much. So that's kind of a big fallacy coming out of Washington. But, they're saying drill more now, but in the next 5 years, we want to get rid of you because we want all, kind of clean energy. Well, to build a refinery, to produce more gas, those type of things require very long range outlooks. So, the demand to produce is going to be much more restricted. So while we go through a disinflationary, recessionary environment, oil prices will come down. But on the other side of that, you definitely want to be long energy for the long term because of the requirements on oil and gas to produce an electric vehicle. As an example, it costs about 1/3 of the carbon input to build an internal combustion engine than it does to build an electric vehicle in terms of the actual amount of carbon input going into it. So petroleum is going to be a very important requirement in the future. And there's no desire by companies to go out and drill more under this type of regulatory environment. So the supply demand imbalance is going to remain that way for a very long time. So use opportunities at much lower prices during a recession to start to build positions in oil companies longer term. That's the same thing Warren Buffett's doing.
Definitely. It definitely makes sense. And it also approaches there of what do we want to happen in maybe the short term and what is reality in the long term here.
Right.
So definitely let's keep it going here. One of the areas that I think we need to watch is if we actually are seeing the economy slow down and how fast this is coming. Are you seeing the economy slow down right now? And where is it showing signs?
Well, again, you're seeing this in the manufacturing sectors right now for certain. I mean, you're definitely seeing, new orders slow down. You're seeing that type of thing. What we haven't seen yet, but it is coming, is we haven't seen it on the consumption side. Now we're seeing real disposable incomes have turned negative. We are starting to see a weakness in retail sales. Of course, the recent announcements by Walmart, Target, Amazon about, an overbuilding of inventories is kind of that early warning sign. So we'll start to see this actually show up in the consumer consumption data. And this is the thing to really watch. Personal consumption expenditures. That's the number to watch. When we get the personal consumption expenditures report that comes out quarterly at the same time that we report GDP, when that number comes out, watch that, because when that starts to roll over, that's kind of your key indicator, because personal consumption makes up about 70% of the GDP calculations. So what you and I buy at the gas station, at the grocery store, what we spend on housing, furniture, fixtures, new cars, all that, that's what's driving the economy. And for that bottom 80% of Americans that are kind of really, that live that paycheck to paycheck kind of lifestyle, they're spending everything they've got just to maintain that standard of living. So consumption is going to weaken over the next quarter or two. I think you're going to see a lot of weakness potentially in that PCE number come the second quarter GDP report when it comes out in July.
Well, you already gave us some signs to look out there, but what should investors be keeping their eyes on in maybe the next month or two to really kind of keep in tune with the markets?
Well, look, the thing is market. So, markets predict kind of what's going on. And the markets this year have already been down 18, 20% at times. And the market's already telling you that there's a problem with the economy. And it's already starting to try to price that in. Now, the big risk for investors, and I've got an article on our website out today talking about an earnings recession. While prices have come down, we talk about valuations, right? PE ratios. Forward PE ratios have come down to like 15 times earnings, and that sounds fantastic, right? Stocks are as cheap as now as they were back in 2019. The problem is when you look at the P and the E, the price divided by the earnings, which is your valuation measure, the P has come down, but the earnings have not. Earning estimates are still very elevated. So that still has to come down, which is going to also suppress price while those valuation measures come in line with each other. And that's going to take a little bit more time here. So over the next couple of months, watch for stocks that are starting to form a real bottom. In other words, they stop going down, making new lows. They're actually starting to form a base. And coming out of this, you definitely want to focus on companies that can generate revenue. They have positive income. They have free cash flow. Look for more fundamental qualities of companies. I know there's a lot of these companies like you were talking about the ARK investment funds in the last segment. There's a lot of companies out there that still don't make money. They don't really have a long-term viable track record. Those aren't going to recover necessarily. I'm not saying it's an absolutely no, it won't. But odds are coming out of this that fundamentally stronger companies are going to perform better than these companies that are really lacking trouble. And even Kathy Wood was talking about they've been consolidating their portfolio into more viable companies, because this is going to be coming out of this. You want those companies that have good, viable, fundamental stability, and that's going to lead to better returns over time.
Something definitely to keep on watch, and I think all of us are watching those earnings to see if we get more revisions to the downside. That definitely will be a sign that maybe the bear market is here to stay, at least for the time being. We'll definitely keep on watch all this, and I appreciate you also giving us some other insight. Check out, guys, the website that's down below in the description. Appreciate you coming on, Lance Roberts, Chief Strategist of RIA Advisors and editor of Real Investment Advice. Appreciate what you do for all traders on out there, and we'll definitely keep up with you. So, guys, check him out on YouTube, and we'll keep it going here.
All right. Thanks.
Thank you, Lance, like always. All right, let's go ahead. Let's keep it going, guys. We're going to go towards some more headlines here as we keep it going on Stock Market Movers, where we keep the informational edge in your guys' favor. So definitely smash a thumbs on up if you guys enjoyed Lance Roberts covering a lot of things. We touched there, inflation, how it's going to turn out. What will the Fed do if they start seeing inflation topping out? And of course, what are the best measures of inflation? I think that was a great question. If you guys want to check out that podcast that he did, definitely I would go ahead and do so. Let's keep it going towards the next headline. Looks like we left off on, we talked about Warren. Did we get to Nike? No, we didn't get to Nike. So let's go into that. Let's go back into Nike's earnings. Nike had a good earnings report. It wasn't the worst here, but definitely getting hit hard here after. You guys can see it started to go on up after hours yesterday, and it just got hit hard here after the kind of the earnings call came on. And then even out the open, it pushed on up there. It got towards a high of 114. Then just started cracking on right back down. The EPS was at 90 cents, beating an 81-cent estimate. Sales were at 12.2 billion, beating a 12.7 billion estimate. And it's kind of interesting to see it turn around so much there. DKS, you guys can see, also turned around there. But it's not only this one. You can take a look in the industry here, footwear and accessories. You got also Skechers going down today. Crocs down about 3%. Foot Locker down about 1.2. So definitely showing you more weakness there coming off of the heels of that Nike report. All right, so let's play the game, the classic. I talked about it. Deal or no deal? I used to love watching that game. I can't blame you. So which one do you guys pick? Deal or no deal? Because it looks like FTX said no deal here. Let's talk a little bit about that. So Sam Bankman-Fried, chief executive crypto exchange of FTX, said the company is not looking to having any active merger talks right now. Let's take a look at Hood, see how it's performing in the intraday. It's actually holding up a little bit better than I expected. Let's take a look here at Hood. It tried to get back above $9 today, was failing to hold that. We're right now at $8.96. We'll look to see if we can close above $9. But he did state here that that we're excited about Robinhood's business prospects and potential ways that we could partner with them. And I've always been impressed with the business that Vlad and his team have built, but that doesn't mean that he's also going to buy them out. He did have a stake in this. If you guys don't forget, he did take a stake in this last month. But I mean, I think what happens here is now, do other companies start doing more due diligence on Hood and looking at it as an opportunity? I think you might see eventually someone step in here and take this business. But the question is, at what price? And then, so that's the key here. Like, let's say, even if it went today and it went for like $10, how much is really the upside? Looking at maybe like a buck to the upside. So we'll see what happens here if someone ever does step in and take the Hood. Robinhood, we'll see. All right, let's keep it going, guys. So China's decision to kind of ease some quarantine requirements for international travel is creating hopes for stronger growth and demand to come back into commodities. Let's take a look here as you're seeing Disney. Let's go to Disney here. Disney was holding the gains, now turning around. And I mean, a lot of this has to do with kind of the overall market turning around, but let's talk about it here. Disney was holding the gains here, was trying to get back on up and then failed the pattern here. And you can see here it was trying to hold that pattern, then failed right around here. When it came back, it couldn't hold the support. Once you break support, you could go towards the next level, and you can see it's already making up some of those gains here. A lot of this coming off the heels of Shanghai Disney report announcing that Shanghai Disneyland would reopen June 30th, 2022. Tickets of Shanghai Disneyland are available for purchase beginning tomorrow. So keep on watch. Maybe you get continued positive catalyst coming out of Shanghai Disneyland. So we'll see if Disney is able to make a bounce back. I was talking about it today that we finally make it back above 100, and we quickly rejected that. But we did fill the gap. We've been talking about this gap zone here. Look at the shadow that you just filled in there. You filled that. So now it could come back down and try to take out this shadow underneath it here. So be careful there. I could see it coming back there into the 95 handle and testing that. We'll see if Disney can get off the lows. In other China news, let's go to LI here. LI Auto said Tuesday that it plans to raise $2 billion for U.S. investors through an at-the-market stock offering. So there you have it. You're seeing LI really tumble down. It came down big in the pre-market at 855, bounced a little bit there, and then just started getting washed out. I was watching this one with NIO. And this is why it's important to have the news, because if you had this news, you possibly could have been looking for a nice short on NIO today. Also XPEV. Like always, guys, this isn't financial advice, only educational, but XPEV also making that little bounce. It flushed here right before the open, bounced, and it looked good there for a potential short there. Not a bad one. Once again, LI planning to raise $2 billion for U.S. investors at an at-the-market stock offering. But also in China news, casino stocks were actually up, right? Based on this news, right? So LVS was actually pushing on up. Las Vegas Sands has a lot, well, pretty much all their exposure now in Macau. So you have to be watching this to see if it can continue making lifts. Also Wynn making a nice little push here. But as you can see, a lot of these stocks that had some good gains, giving them up. And a lot of this probably the SPY still dragging there, guys. Now down to 382. So looks like the bulls are getting stuck here and having to make a decision if they're going to let go. I think they're going to start letting go as you keep seeing this come on back down through levels here. We'll see if this can hold here, or does it break down and continue on the downside here. Overall market definitely dropping there. All right, let's go ahead. Let's continue here. Like always, we're going to continue pumping along. It's 141. We just talked about the casino stocks having exposure to Macau, which is definitely something to keep on watch. Now let's go into the cryptocurrency concerns. They continue, guys. So cryptocurrency exchange, we got here CoinFlex is raising $47 million through a new coin after a major investor fails to pay debt. CoinFlex CEO Mark Lamb said here that in a blog post that in a longtime customer account went into negative equity by issuing the new RVUSD tokens. CoinFlex was hoping to raise enough money to cover the shortfall in its books. Definitely not what you want to be seeing, as you're seeing more and more mentions about concerns on platforms in cryptocurrency. This just shows us that we need to keep this on our radar. Like always, make your own investment decisions, guys, but risk management always. That's what I would talk about. And you guys can see here, these exchanges are just having issues. It's almost to the point where I would expect issues at this point. And that, I'm not saying that that's what you guys should do, but at least in my eyes, I would definitely expect issues at this point. Seeing so many platforms having issues, so many names having issues, hedge funds blowing up. I mean, it is a lot of concern right now in cryptocurrency. And it just shows me that for right now, at least in my eyes, it's a stay away. All right, let's keep going into the news. Let's go to Airbnb here. Getting a little bit of a bounce lately. So let's take a look at the chart. It's coming down today. It's down there to $98, guys. I don't think we were expecting to see Airbnb down here. And this is why you always want to let one go. because I did take a trade back on up here. And what happened? I ended up stopping out. And what would have happened if I would have stayed in the trade? I would have been holding a big bag there in Airbnb. But what happened today? And what's the news here? So Airbnb on Tuesday announced global ban on parties following a temporary restriction it put in place 2 years ago. So a lot of people had noticed that, a lot of people like to do parties at Airbnbs. They like to rent it for one day and do like a big event. But this is just not acceptable by the company anymore after, a lot of these have gone really the wrong way. A lot of them having police involved, theft, and there's just a lot of concerns here. So they're completely banning it here, finally making it permanent here. The company is permanently banning disruptive parties and events, which include open invite gatherings, party houses, which people book to throw a large event for just one night will stay banned also. So keep this on your radar. It's going to be something to keep on watch to see how Airbnb can get around this. But they've been doing this now for 2 years. So it's kind of like nothing new. They just kind of permanently put it in there. All right. The next topic is, of course, from Spirit Airlines as they continue to battle, guys. They're trying to get Spirit, JetBlue stepping up with their takeout offer again here. And this also just trying to take it away from, of course, Frontier. There's an existing deal there as they keep trying to push there to kind of increase the takeout offer. We'll see what happens if they're able to take this out. But like always, you never know when it's kind of these takeout offers where things end up. All right, guys, so let's go ahead. Let's get into our second interview of the day. I tried to tell you guys that we would get to 2 expert opinions always, but today we did have a cancellation. So what I'm going to do for you guys is I'm going to do a little bit of some replay action from yesterday. So if you guys didn't catch yesterday's interview, well, you're in luck. But if you did catch it, well, try to catch some little small details here from Adam Johnson and I's conversation from yesterday and see if you guys have something that we can talk about and expand on once the interview is down. So I'm going to go ahead and put it on up here. You guys let me know in the chat, in the comments. I'll comment with you. What do you guys think about what he's saying here? And let's go ahead. We'll go back and forth in the chat. Let's go ahead and check this out. Let's bring on Adam Johnson here. Welcome to the show, Adam Johnson. This is the portfolio manager and advisor investments and also American Ingenuity strategy. How we doing, AJ?
Hey, doing great, Money Mitch. It's great to be with you. It's been, I don't know, a few months. You're right. It's been too long, but I think we've all been kind of hibernating, just trying to survive. I think the good news is we're coming through this whole thing. I think the 2 E's of earnings and employment matter more than the 2 R's of rates and recession. So it's good to be back. There may be some red on the screen today, but I think the future is a lot more green.
I'll tell you what, Adam, I've been watching your interviews also. It's not like if they're not on here, I don't watch them. So I will get into some of the things that I've been watching you mentioned. Let's talk about the market bottoming out and what are the 9 signals that you use? I've heard you mention these before. And what should we look out for?
Yeah, it's the checklist. I call it the Are We There checklist. And Mitch, I've been able to check about 7 of them. Just to keep it simple, think about stuff like this. The percentage of stocks in the S&P 500 below the 20-day moving average, that's 98%. The percentage of stocks below the 3-month moving average, that's 95%. Anytime you get either one of those percentages above 75, that's a washout. And again, we're at 98 and 95. So check 2 items off that list. You look at the ratio of bears to bulls. Right now, it's about 3 or 3.5 to 1. It actually was as wide as 4 to 1. That was the most negative since 2008. And anytime you get it above 3 to 1, again, that's something else you can check. The number of bulls, the lowest since 1990. Again, that's something else you can check. The volatility index inverted. It's been inverted for months. Again, something we can check. 7 of 9 items on the AJ Are We There Yet checklist. I've been able to check off, Mitch. The 2 I haven't, the VIX, the volatility index, I know it's inverted, but I actually like to see it go above 40, where you get that ultimate sell-off and everyone just says, get me out. And then the other thing, which is related, is the put call ratio. You get that above 1.4, it's gotten to 1.36, which is close. And again, that's just telling you that there's total capitulation. So 7 of my 9 I can check off. The VIX and the put call I can't quite, but again, pretty darn close.
Yeah, it seems like we've been having recent relief rallies. A lot of question on out there if this is one of those. I would like to ask you, how do you feel about today and the bottom put in or not? And of course, what should we watch to see if we do get that bottoming action? Of course, there's the 2 that you mentioned there that you're keeping an eye out for.
Yep.
But what if we don't get those? Would that still be kind of a mode where you'd be like, well, then I'm not going to go fully in on calling the bottom here?
Well, admittedly, I don't think there's any money to be made in fully calling the bottom. There is money to be made in picking high quality stocks that are down on the lows and owning them over the next year or 2. I'm an investor. In fact, if I need to wait 3 or 4 years, I'm happy to do that. I'm not a trader. So I'm not going to try to tell you the bottom's in, there it was. What I will tell you is that I have been buying. I do believe that bottoming is a process, and we are well into that process. If you think, Mitch, about what happened or has happened over the past several months, first it was all the growth stocks, all the, Cathie Wood, ARK ETF growth stocks that got crushed. Then it was the FANG stocks, starting with Amazon, then Facebook, et cetera. Even Google and Apple have gotten hit. Netflix, no need to go into that one, Nvidia, et cetera. And then it started to rotate through to industrials. And then the banks made new 52-week lows. And then if you remember when Target blew up about a month ago, the retailers all got crushed. Bitcoin over the past couple of weeks. So my point is there's been this rolling bottom in the market. And even though in the past, what we've typically seen is everything go down and make a low together, in this particular sell-off, this particular bear market, it's not unfolding that way. It's, as I say, this kind of rolling bear market. So I'm not sure we're necessarily going to get the one crazy day where everything looks horrible. But I will tell you, Mitch, there have been, as you know, a lot of crazy days. And 2 weeks ago, when we were down, 12% over 4 trading sessions, that felt pretty crazy and pretty ugly. I did some buying. I'd rather be buying in here than selling in here. So I can't answer your question. I can't tell you definitively the bottom is in. All I can tell you is what I'm doing, and I'm buying.
Love it, love it. And I agree with you. The bottoming is a process. A lot of people are trying to put it on one particular kind of number, indicator. Right. The truth is that you probably won't know that the bottom's in, because that's what it does. It's a bottom. It's a bottoming, right? And it's not about catching that that first 1-2% off the bottom. I love how you're mentioning that, Adam, and definitely taking a view of it as an investor. One of the things that I'm kind of keeping on watch is kind of the separation here with growth and value, right? Because one of the things that I can start seeing, and we could pull up ARKK or maybe to take a look at that, but I'm really starting to see a little bit of growth, catching a little bit of that bottoming action. Maybe not taking out the lows that we had a couple of weeks back. What do you see in growth stocks here?
Well, look at the large cap tech companies that have led for so long. And now I'm not necessarily talking about the FANGs. I mean, sure, we could talk about the FANGs, but to just broaden the conversation, you look at a Salesforce.com, ticker CRM, or you look at Square, now called Block, Jack Dorsey's company, ticker SQ, PayPal, PYPL, on and on. I mean, these are some, Nvidia, a great example, which I admittedly already mentioned, but just to broaden out the conversation, these are some very exciting, very well-established, very solid companies that are growing both the bottom line and the top line. In some cases, significant double digits. We're talking like 20 to 30% growth. And yet a lot of these stocks are, they're down 50, 60%. So yeah, actually at this point, I would even argue that growth is starting to look like value. And you may even have noticed that Metaverse, otherwise known as Facebook, was just added to the Russell Value Index as of last Friday, trading at 12 times earnings. So there's become a fuzzy line between growth and value at this point. So many growth stocks have just been thrown out that, they now look like value stocks.
Yeah, also to mention, I mean, I know Netflix was also a part of that ad, so it wasn't a company that I would have been looking at for value, but definitely you're mentioning it right on the nail there. Let's go into energy and the pullback, right? Is this just more of a correction, or do you see also opportunities here in energy as we got in this correction in the last 2 weeks?
Sure. Well, I'm a former oil trader, so I love talking about oil. So thanks for teeing me
Hey,
up.
there you go.
But I will also tell you that I would rather own beaten down tech on the lows than broken out oils near their highs. Though, as you point out, they're off the highs. I tend to think that the oil, or that the bud is kind of off the rose in oil. They've had such a huge move. And here's the other thing. The world is producing as much oil as it possibly can because every barrel of oil is profitable at current prices. Whether you're talking, off the coast of Argentina in 7,000 feet of water, or whether you're talking the oil sands of Canada, all that oil is now profitable. Now, that's not to say you can just flip a switch or suddenly get the rigs on site and start bringing it to the surface. Even if you can do that, you still have to transport it. You need pipelines, you need ships, you need rail cars, etc. So it's not just as easy as saying, oh, price is high, let's go. But my point is, the world is adjusting quickly. Look, you probably read over the weekend that President Macron of France is saying, let's bring the Iranian oil back on. The U.S. is using backdoor channels to actually speak with Hugo Chavez in Venezuela. Amazing, right? The U.S. would rather do a deal with a dictator in South America than our own exploration and production companies here in the U.S. That's because the administration doesn't want them drilling on federal land. But my point is, there's a lot of marginal oil that's starting to come onto the market. And we haven't completely made up for the loss of the Russian barrels that were being exported. That'd be somewhere between 5 and 6 million barrels, but we've got about halfway there. So there's a lot of oil that's starting to come on. I think more oil will come on. And if there's any let up in the war between Russia and Ukraine, I think you could probably see oil, and I'm just pulling this number, admittedly, it's not an exact science number, but my guess is you probably take $20 off the price of oil just because you're taking the war premium down. So for all those reasons, I would not be a buyer of oil stocks at this point, Mitch.
Yeah, it sounds like you agree that the opportunity has come and probably passed. Maybe there's some gains there to be made, but definitely the opportunity has come and passed. Let's take a look here at the overall economy. Do you see kind of a strong economy? I know that when we go back to kind of Powell's comments, he had stated that he saw no slowdown in the economy. What do you see out there, Adam?
Well, I'm not sure you can necessarily say there's no slowdown. I mean, just intuitively, you would expect that housing activity would back off as rates go up. And I know JP Morgan just laid off a few hundred people in their mortgage servicing department last year, or mortgage originations. But I will tell you, Mitch, that I think we've gotten way too negative. I think the two E's of earnings and employment ultimately matter more than the two R's of rates and recession. At the moment, or I should say over the past couple of months, all we've been able to focus on are rates and recession. We have let that narrative completely overwhelm the positive narrative of earnings and employment. And that's why I say, ultimately, I think the two E's matter more than the two R's. We're not quite there yet. We're starting to see glimmers of it, but I think people have gotten way too negative. I respect Mr. Powell for being as positive as he is. I've been very positive too, and admittedly some egg on my face, but just consider the fact that over the past 2 weeks, according to the TSA, there have been 2.4 million travelers through US airports each day. That's back where we were at the height of COVID, when not only was it leisure travel that we were seeing, that was also accounting for business travel. And right now, business travel, according to Delta, is a fraction of what it was, only about 30%. In other words, we're at 2.4 million passengers per day just because you, me, and everybody else wants to go out there. That's powerful. I think consumers are in a very good place, and they're out there spending money. So I'm bullish on the economy, Mitch.
Truly interesting there. Definitely something to keep on watch. And I like how you mentioned there the separation between consumers and business travel. So good numbers to keep an eye out. Now, where can investors, start looking for maybe some plays? I myself, and I'm also in the camp that, you can't stay out of the market for too long. You always got to be looking to start dipping your toes.
Yeah.
Where do you see opportunities out there, Adam?
Yeah, time in the market, not timing the markets, right? So I think you and I agree on that. Normalization. There's some wonderful, I just mentioned air travel. I mean, look at Delta Airlines. I know some of the headlines have been kind of unattractive over the past weekend because Delta pilots were protesting, saying they had kind of lost faith in management's ability to run the business in a quote unquote responsible manner. What they're really getting at is that Delta and all the airlines had to furlough pilots, and they basically parked airplanes in the desert, where they don't rust. And demand has come back so strong that they're bringing planes back and pilots back, but not fast enough. And so some of the pilots are being overworked, and that's why they've been protesting. But that particular detail aside, I think Delta is a very exciting company to own for normalization, getting back to normal. It's trading, call it a 6 PE. They're back to making money again. People are traveling. I think that's exciting. Wynn Resorts, which is also benefiting from the reopening that we're starting to see in China. 2/3 of their money comes from Macau, the casinos off the coast of Hong Kong. So Wynn Resorts is something that I think is interesting. Expedia, just booking travel reservations. United Rentals, trading at 6 or 7 times earnings, the largest renter of industrial equipment. Industrial America has taken some heat, but look at durable goods and capital goods orders this morning, both better than expected. Factories are operating close to capacity. They need to rent that equipment. That's United Rentals. So I think there's some normalization plays out there, both travel and industrial.
Definitely. I'll do a little bonus action. You guys first smash up that like if you guys get a little bonus here. I'll throw a bonus question. How do you feel about emerging markets like China plays that we're starting to see come back a little bit with these tech names? How do you see it out there, Adam? Is these opportunities to maybe catch an emerging market move before ours catch a bottom?
Well, my whole thing, Mitch, is American ingenuity, right? The people and companies driving the world forward based
100%.
here in the U.S. So I'm not going to be able to go out and wave another flag, but I will tell you that as the world normalizes, that's a powerful tide that will lift a lot of boats from emerging markets to even beleaguered Europe and beleaguered England. Again, I want to focus on the U.S. That's all I do. I don't own companies outside the U.S., but we've gotten so negative, far too negative, that as the U.S. economy comes out of this hole, that will help other economies around the world get out of the hole, normalizing supply chains. I won't touch China. For me, that's a no-go zone, but there's certainly plenty of people who are talking about the fact that China Dragon Index is way off the lows over the past 2 weeks.
Something to definitely keep on watching. I'll throw it to the audience. Definitely, guys, give Adam Johnson a follow. AJ Insights. You guys can check out all the work that he does. Thank you for coming on, Adam Johnson, and we'll definitely have you back.
Okay, sounds good, Mitch. Thank you.
All right, team. I hope you guys got something out of that. I'm sorry that I didn't get you a brand new expert today. We did have one set up. Once again, we had a cancellation. Hope you guys enjoyed that replay from yesterday of Adam Johnson. He's out of New York and sometimes even on studio with Fox Business. I know that a lot of people, are going to keep him on our radar. We see him talking all the time, whether it's on here on Benzinga or other networks. So keep Adam Johnson on your follow list. That's AJ Insights on Twitter. Let's go ahead. Let's wrap on up. We're going to get on out of here, guys. It's 2:00. You guys got a brand new show coming on next. How to prepare for Reg A Plus by Benzinga times Delmore Group. So check that out, guys. It's going to be coming on up. If you guys want to find out about what a Reg A Plus is, go ahead and hit the link, guys. You guys haven't got to go nowhere. Just stay right here on Stock Market Movers. And, of course, Benzinga will get you on over. All right, guys, hit the like button. That's going to do it for us today. We covered a lot of action today. We covered consumer confidence index, retail stocks, April home prices, ARK Invest, bank dividends, Warren Buffett, Nike, Robinhood, Disney, cryptocurrencies, and Airbnb, with also expert opinions mixed on in. So hit the like if you guys enjoyed this show and how many things that we go into on a daily basis. We'll see you next time. Now, go ahead and check out that new show that we just started.